Good morning. Welcome to FLIA's Real Estate Direct Lending and Private Debt Forum Part 11. We would like to thank our event sponsors, Apex One Investment Partners, First Lien Capital, Ground Floor, Millennium Trust Company, and Preqin. We'd also like to thank our sustaining members, First Lien Capital, Preqin, Sunstone Property Trust, Allagash Partners, Apex One Investment Partners, Boomerang Capital, S&P Global Market Intelligence, Nationwide, Mercadine Automated Properties, Millennium Trust, Intrust Global, Off the Chain Capital, Robo Capital, EMQQ, Sheridan Asset Management, and Safe Harbor Equity for making this event possible today. Also, we'd like to thank our FLIA board members for their support during these challenging times. For those of you not familiar with FLIA, FLIA is a 501c6 nonprofit organization started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investment education. Since then, FLIA has helped thousands of firms in the capital raising process, aided in the allocation of billions of dollars to alternative investments, and leveraged technology to accelerate the due diligence process. Today, FLIA as an organization has approximately 10,000 members on the platform with over $5 trillion in discretionary AUM. Thank you for attending and enjoy the day. Our first panel is called Capitalizing on Real Estate Opportunities in a Post-Pandemic World. The panel was organized by Ernest Johnson of Apex One. We'd also like to thank Apex One for being a sustaining member of FLIA. Ernest?
Great, thanks everybody. I appreciate y'all taking some time today to attend. Most of y'all know that I live in Houston, Texas. I've since abandoned the town because of the cold weather and freezing conditions down there, but certainly our thoughts and prayers are with everybody impacted by this generational storm. I'm ready for a little global warming down here in Texas, so we'll see what happens. I'd also like to thank FLIA for allowing us to host this panel. Mike and his team have done a tremendous job in helping Apex One establish itself as one of the leaders in the multifamily investment community. And Michael, thanks to you and your team for great work. I'd also like to welcome Mike Price from Balfour, Beatty, and Aaron Cardwell from Bricadia, two of my partners that we've been working with for some time. And I'll let them introduce themselves in just a minute, but I wanted to talk just briefly about our presentation today. This is not a multiple choice event where we're going to show you the markets that we think where there's going to be great opportunity, but rather we're going to show you what we've dissected in terms of the economy and what we think the post-pandemic world is going to look like and how that's going to filter down into real estate decisions that people are making, whether those decisions are where they rent. And then if we have a little time left at the end of the day, we're going to talk about the office and retail and a few other sectors out there and how they've been impacted by the pandemic. And of course, this all shapes where we invest in properties, where we think markets will be recovering, where we think markets are going to look a little different. And we're going to take you through a step-by-step process of how we evaluate markets. And then we're going to show you 3 sample markets and how these factors play in. So I hope what you take away from this is one, as you look at real estate investments, whether it's with Apex One or whomever, you'll think about some of these factors that we talked about. And this presentation is available if anybody wants to see it, in terms of how these factors might drive your real estate investment decision. So with that, we're going to move forward to the all-important disclaimer and disclosures. Review at your leisure. And I'm, of course, Ernest Johnson. I'm a partner and executive managing director with Apex One Investment Partners. I focus on our capital markets, fund strategy, financial administration, et cetera. I was previously with JMB Property Company and PM Realty Group prior to joining Apex One. In what little spare time I have, I serve on the advisory council for Auburn University's Master of Real Estate Development program. I went to Auburn. I'm also on the University of Florida's real estate program. And a couple of years ago, the University of Florida's program was named #1 in the country. And I often remind my friends in Florida that it took somebody from Auburn joining their board before they got to #1. So we have a good time with that. But thank y'all. And at this time, I'd like to introduce Mike Price from Balfour Beatty Communities, Senior Vice President of Residential Transactions. And Mike, can you give us a little background on yourself?
Sure, Ernest. Appreciate it. Like Ernest said, Mike Price with Balfour Beatty Communities. I'm lead our asset or acquisitions group at Balfour Beatty. We own and manage over 50,000 units across the country in a few different asset classes, including conventional multifamily, student housing, and military housing. I've been with Balfour for 14 years through various departments, asset management, finance, and now on the acquisition side for the past 7 years. And prior to that, I was with the largest student housing operators in the country at the time, prior to being purchased by Balfour Beatty. So our focus currently is in the conventional and student housing space, and investing on behalf of our shareholders. And we've partnered with Ernest and the Apex One team on probably over a dozen transactions, I think, at this point over the past 6 years, and have used Aaron and Berkadia on a number of those transactions on the lending side, who you'll hear from after me. So that's kind of Balfour Beatty in a nutshell, and what I'm charged with at the moment.
Mike won't mention it. He's too he's too well behaved. But this past year, Balfour Beatty Communities was named the number 10 in terms of overall quality of performance of property management companies in the residential sector. That's a tremendous achievement. They actually jumped over some of the really big names in the industry to earn that top 10 honor. And that's not ranked by the number of units you manage and own, but it's ranked by tenant satisfaction, investor satisfaction, a lot of other factors in there. So Mike said we've done a dozen deals with them, which we have in terms of joint ventures, but I think they've managed 6 or 8. We have about 18 transactions with Balfour Beatty. They are the largest construction company in the UK and one of the largest in the world. And we just really appreciate the institutional discipline they bring to our organization. But more important, we really appreciate the way they treat the residents in our communities. We're a big believer that returns to investors begin at the residents' front door. And I think Balfour Beatty realizes that these are apartments, but this is somebody's home, and they treat their residents accordingly. And Mike, congratulations to you and your team on that top 10 designation, well earned. For out of the thousands of people that do this, that's quite an honor.
Appreciate it. It's something we're extremely proud of.
Well, you should be. And Aaron, give us a little background on our good buddy Aaron Cardwell, Senior Managing Director at Berkadia.
Sure. Thank you, Ernest. My name is Aaron Cardwell. I'm a banker with Berkadia. Berkadia is a commercial mortgage investment bank based out of Philadelphia. We are sponsored by a joint venture of Berkshire Hathaway and Jefferies. Most people know who they are. I've been with the firm since 1998, including our predecessor companies. We are the largest non-bank servicer of commercial mortgages in the country. And so we have great data and great insight into the market. I raise capital on behalf of my customers, whether that be debt or equity capital. I've been doing business with Apex One and Balfour for quite some time, and some of the principles of Apex One going back almost 20 years. So very pleased to be here. Thank you for having me.
Right. So what you have on this panel, to the people that are listening in, some very interesting perspectives. First you've got myself that goes out and raises money from y'all, and I think a number of our investors are on this call today, looking for deals to invest in. You've got Mike Price, who is out there on the streets looking for deals to buy, utilizing the capital that we raise. And then you've got Aaron Cardwell, who provides debt on these projects. So, Aaron's putting in a lot of the money. We're putting in a lot of the money. Mike's putting in the time. So you've got some very interesting perspective on how we all evaluate deals. And I think as we go through this presentation, you'll appreciate the effort that the team goes through to select transactions. We'll go about Apex One in just a minute, but I wanted to jump into what you're going to see in the slideshow. We think this is about identifying opportunities at what we call the intersection of data and experience. To give you a little background, back when the pandemic first hit, Mike and his team and Apex One, we started looking, and we had a little spare time on our hands, and we started trying to evaluate why some of our projects had performed so well, just way outperformed. We knew we had some good tailwinds, but we thought there had to be other factors. So Mike and his team started digging into hard data points, items that were measurable that you would get from reputable sources, and looking at the communities where we invested, and we started seeing some high quality traits of those, and we'll show you those in just a minute. And I don't know if it's Mike or who on his team had the broad idea of, well, if we can do this for the communities we're in, let's do it for the entire country. So 3,142 counties and parishes later, which comprised over 10 million data points, they put together a spreadsheet that's so large you literally cannot send it by email. And it's how we break down our markets. Aaron plays an interesting role in this. When we were looking at a deal at the beginning of the pandemic in Birmingham, Alabama, we pulled out of our deals, and we kept checking these deals and kept checking the markets. And Aaron brought some data to us that showed how some of the markets in the country seem to be resilient to COVID-19 because of their economic and employment base. And so we baked that into these data points that Mike put together, and with Mike and his team came up with what we call this Great 8, these evaluation points that we look to evaluate, looking beyond just the data and the numbers, but trying to figure out what's driving these particular markets. And so we all played a role in this. We'll have a little panel discussion and then some Q&A. So if anybody has any questions, please pop those up and let us know. So moving forward here, let's get a slide. There we go. Just a little about Apex One. I told Michael I would not turn this into a commercial. We've now successfully launched 4 real estate funds. Our 4th fund was launched about 90 days ago, which is looking to capitalize on the post-pandemic market. We are buying properties from distressed sellers, not distressed properties, and I can tell you about that at some other time. We've been very successful so far. Our 3rd fund, we raised $108 million. It took us 18 months. In our 4th fund, we raised $108 million in 60 days, and we're now at about $134 million, I believe, raised. We have 2 properties under contract, one in San Antonio, one outside Baton Rouge, and we'll close on those in March, and the fund is still open to investors. These are just the terms of Special Situation Fund. The one everybody immediately goes to is the minimum investment of $1 million. That's for institutions only. Individual investors, we waive that and allow you to come in at an amount that you're comfortable with. But again, promise not to make this into a commercial. So here we are at the intersection of data and experience, the Apex One multifamily investment strategy. What do we do and how do we use it? So the first phase is research. And I think I mentioned this to you, the work that Mike had done. We have to understand what the market drivers are in the places where we're looking for property. We look for economic diversity and resiliency. We like managed supply, and we like to understand the demographic trends. Those are the market drivers. We then ask ourselves, what can we do with these properties after we acquire them? Are there unique property characteristics that are present or can be brought forward? What's the appropriate amount of leverage that we use? And we work with Aaron and his group on that. We look at diligent operational management. One of the real surprising finds that we've seen over the last 5 or 6 years is how well people react to improve management. And when I say react, it means their willingness to pay more rent to be in a well-managed property. They tend to not be as impressed by the latest and greatest upgrades in the units and the latest and greatest common area if the properties are not managed well. And so we've always been very pleased at the way that our properties are managed and that our residents react to that. And then the timing of the disposition, the oldest saying in real estate is you make money on the buy, but you collect it when you sell. And so knowing that timing of disposition is our operations. So what that all means is at Apex One and working with our friends at Balfour, Beatty, and Bergstrom, we harvest data from every county, parish across the U.S. to determine investment viability. We collect that, filter it, and then apply it to the markets that we're interested in investing in. These are some of the multifamily data dynamics. Again, I think that most people just don't understand all the bits and pieces that go into analyzing whether or not this is a market or a property that you want to be in. And you'll see some interesting ones in there like weather patterns. We'll discuss some of these in greater detail as we go through the presentation. So now I'm going to start bringing the panel back into some of the conversation. And so again, what we did, we took these data points. This represents those 10 million data points that we collected. And then we put them into a filter and started looking deeper into which markets we should be looking into by, giving certain drivers and filters that we would use to evaluate this information. And so the first thing that popped up, and I don't think anyone's gonna be surprised by this one, and Mike, I might ask you to comment on this, but pre-COVID growth and rental demand, why was that important in your evaluation?
Well, I mean, we think it's important just to understand, what has been happening in certain locations and certain MSAs, and whether we think it's sustainable going forward. And we have some, commonalities where, obviously projects are performing better than others when they have these characteristics. And there's some underlying factors that kind of drive each of these as well as we go through this presentation that kind of weave its way in. But these are just kind of the starting factors of understanding what's going on really in the infrastructure and the demand at certain locations. And then we've kind of tried to project forward in this kind of post-pandemic world with other factors, whether they're going to be sustainable. And there's certain markets that we think will absolutely kind of pass through this with just a slight blip, and others that may take a little bit longer to come out of, depending on what the underlying characteristics are.
Mike, so let me ask you this. I noticed that we have 8 of these factors, and I think the way that's helpful to explain to the audience is that the more of these factors, the more of these boxes you check, the better we think that investment market is, because obviously someone like New York and San Francisco and others had great growth in rental demand prior to COVID-19, but that's probably going to drop post COVID-19. So while they might get a check for this mark, they wouldn't benefit from some of the others as well. So again, I think it's important that the audience understand that just because you fit one box doesn't make you good. It's the number of these 8 that you can hit, and we'll show that in a city evaluation in a minute.
Yeah, we looked at it. We looked at it as an aggregation of all of these, and which locations cover more of these factors, and aggregate them up, and which ones boil to the top as far as where we think you'll have the best chance of success.
Yeah. Now, Aaron, I've pulled up the second slide. We like communities with diversified employment and economic resiliency. We found that as a factor. And you were one of the early ones to point out that there were certain sectors, especially on the government enterprise, that buoyed some of these markets like a Birmingham and an Austin that actually held up very well during economic growth. When you're looking at loans and evaluating projects for your borrowers, how do you look at the diversified employment and economic resiliency in those markets?
Yeah, it plays a big factor in our decision making for credit. As you can imagine, let's take a market like Las Vegas, which it will probably come back in force and hopefully be better than it was before. But as you can imagine, going into the pandemic, call it March, April, May of last year, although the economy there is much more diverse than it was, say, 3 years ago, it's still largely tourism focused. You compare that to a market like Birmingham or Austin, as you said, Phoenix, parts of DC, where you have government concentrated jobs. Those people were not worried about whether or not they were going to get their paycheck, because those jobs, always are there, and the government, pays regardless. Whereas if you're planning on going to Las Vegas, you don't need the croupiers, because there weren't people there. In fact, as of right now, I just saw a headline this morning that MGM is finally opening up several of their hotels, which have been closed effectively since Thanksgiving time, and that's a lot of lost revenue. So it plays a big part in our credit decision for sure.
Something that I thought was interesting on this slide on evaluation, I'll just comment before we go to the next one, is the one on the bottom right where it says education. And people might say, well, what does that have to do with diversified employment and economic resiliency? We think a number of the high growth job sectors going forward are in the high tech area that require maybe a higher level of education. And we also find that companies, someone like an Elon Musk relocating parts of Tesla to Austin, they like to know that the city they're going to has a good education system in place, not just well-educated people that come in from other areas, because they think that's important to attracting the types of employees that they want in those sectors. So all these little variables, seeds that get planted play a role. The next slide, I think is kind of interesting, strong healthcare and medical facilities. Again, when we look over the last year and what's going on right now, concern for health has risen dramatically. And so we think that communities that have robust healthcare facilities, including, good, strong research hospitals. So one of the things that we look at as we're doing our evaluation of communities is what is the percentage of people employed in the healthcare and medical facility, like a Houston, Texas, the number of beds that they have available, the physician population ratio, et cetera. So again, just one of those factors that 24 months ago probably didn't play as big a role in our evaluation, but today it's something that we always look at. In fact, this property we're buying outside of Baton Rouge in Ascension Parish, Louisiana, is a quarter of a mile from the hospital, because we think there's going to be tremendous growth, and that's where the county is going to, the parish is going to spend more money. And so we think this has an opportunity to attract some healthcare workers into that facility. So that played a big role in our decision to acquire that property. Mike, did you have any comments on the healthcare, or do you want to take the next slide?
No, I think that's accurate. There's other markets, that historically, I personally, I've ever looked at from an investment standpoint to push on, but this slide and this piece of information on the medical side, and quite frankly on the education side, Philadelphia is known for their eds and meds city. That's what they're known for. So it's kind of refocused Philadelphia as an investment opportunity in our mind going forward.
Agree. I say exactly. The next slide is kind of interesting, the strong state unemployment funds. You may ask, what the heck does this have to do with apartments? Well, we know that the past year has been a real strain on these state unemployment funds. And so we want to know what's the job growth and population growth in the states. And the reason is that's typically where most of the money to replenish these funds come from. So if you have a state that's losing people, i.e. New York, California, you're not going to have as much money to pull back into that system. And you might start looking for alternative revenue sources. And we certainly don't want that to be apartment complexes. So we also look at the strength of those states. And there is a listing that we have of how much money they have, where they get their source and where they get their money from. And so that's played a role in our decision. Whereas again, 18 months ago, Mike, I don't think we were really looking at this in terms of a evaluation piece.
No, that's correct. This is another one that's kind of bubbled up as people, quite frankly, are moving between states and choosing new locations to actually live and possibly work in a completely other state. So it's definitely bubbled up from an evaluation standpoint.
So this one's probably not going to surprise anybody. We think the markets where there's research, technology, innovation hubs, and universities. Again, this goes back to education. We think these are a lot of the sectors that are going to be growing. Aaron, when y'all are, again, I know y'all look at the markets as much as we do. How does Berkadia feel about these types of markets, and how do y'all help identify these types of markets when you're putting loans out there?
Yeah, so anytime you're close to a high quality university, a top tier university, there's a multiplier effect, just by virtue of proximity. Some markets you wouldn't think of as having dynamic and positive attributes, oftentimes have them just by virtue of location and proximity to a research university. For example, Tucson, Arizona, not a place that anyone thinks of as particularly sexy. It's hot, it's dry, it's not very pleasing to the eye, but it has a very good school there, the flagship research university for the state. And what as a result of that, there's a number of very high quality employers, Northrop, Intel, Raytheon, to name a few, that as a result of being close to the school have high quality jobs, lead to population stability and growth. And that kind of dovetails to your prior slide as well, Ernest. So it's certainly something that we consider.
Mike, when you put together that super mega 10 million data byte Excel spreadsheet, one of the things you did was you came up with a ranking system by counties, and I was pleasantly surprised, but not shocked to see that my old hometown of Huntsville, Alabama, was listed. This, and Mike, I'm not going to ask you about Huntsville. I was just thanking you for listening, but I think Madison County, Alabama, was listed in the top 25. And to me, this is just one of these interesting things that came out of this research program that Mike and we undertook. So every technology-centered town in the country wants to be the next Austin, Texas. It's like every basketball player wants to be the next Michael Jordan, and I guess every football player wants to be the next Tom Brady. Everybody wants to be the next Austin, Texas, and they reach up to claim the crown, and it seems to topple off the head. But Huntsville, Alabama, is emerging as one of those towns that actually might be the next Austin, Texas. Going back to its deep roots with NASA and Warner von Braun and all the technology that spawned off of the NASA programs. My father worked for a company that was a subcontractor to NASA, and they created all these technological advances that they could later sell to the private communities. The U.S. Army has located their worldwide purchasing program there. And so it's just booming. Another town that I saw on that list, known for different reasons, is Augusta, Georgia, because the U.S. Army has relocated one of their high technology groups, their cyber spying organization in Augusta, and it's apparently creating just a great number of jobs besides golf course maintenance down there. So this was a real interesting slide, I thought, that y'all put together, and some of the morsels that were being dug out. And I think the other thing we're seeing is there seems to be a desire by some of these big technology companies to diversify out of their mothership and spread the love around the country. Is that something you're seeing, Mike?
Yeah, I'll echo, the Huntsvilles and the Augustas and the Ann Arbor, Michigans are three of the ones that top the list just from that perspective on the research and tech side of things. I mean, Huntsville has one of the most highly educated workforces in the country, to be honest. But yeah, I mean, you look at companies like, Facebook out of Silicon Valley, they're gearing up to make 50% of their workforce outside of Silicon Valley. And they're looking at cities like Pittsburgh, Philadelphia, Denver, Austin, of course. So it's something that we're keeping an eye on, as this kind of possible more virtual workforce moves around, and companies may branch out into these different highly educated cities instead of staying in their kind of Silicon Valley bubble. So it's something that we're keeping an eye on in some of those, non-gateway markets where you have highly educated workforce willing, able to do the same job that folks in Silicon Valley could do.
Is this the category you put the so-called, quote, Zoom towns like Chattanooga, Tennessee into?
Yes. Yep.
Yeah. Aaron, how do the lenders feel about the Zoom towns? Chattanooga used to not be very sexy, but suddenly we see a lot of activity in markets like Chattanooga.
For sure. The lending community loves them. And as a matter of fact, some of our lenders in Chattanooga, as a matter of fact, one of our correspondents actually, a large life insurance company moved a large portion of their people to Chattanooga for that very reason, which 5 years ago wasn't necessarily on anybody's radar.
Yeah, good one. So the next slide is ease of transport, and I thought this was an interesting one, but then I reflected back on the early days of the pandemic when we saw the empty shelves of bread and water and paper towels and toilet paper and all those necessary things. And you realize, and my brother's a long distance truck driver, and he's had the busiest year he's ever had in his life, that you've got to get product to these towns, and there are priorities in terms of where product goes. And so we thought that, access to transportation was going to be a big driver in the post-pandemic world. Even as we move more towards technology, how adaptable the cities are to alternative transportation options such as Uber, driverless cars, things like that. So, again, it's just we thought cities that were thinking, looking forward on transportation, also the ease of, good airport transportation was going to play a big role in decisions going forward. The next one I thought was also interesting, and maybe Mike can comment on this a little bit, but climate. Again, we thought that, we've always been a big believer in green programs in our communities. We, for instance, put energy, low energy saving appliances in our apartments. We realize a lot of the people who live in our apartments, cook meals there 5, 6, 7 days a week. And they appreciate the fact that we're lowering their cost. And we've also found we go to dispose of our properties to sell them, that the buyers give us a little more credit for having an energy efficient apartment. And then there's been some benefits through some lending programs that's helped us as well. So, being good monitors of the earth and environment has been good for our investors as well. But we also think that as companies look to relocate to towns, again, using Tesla going into Austin, I'm sure that the way that Austin approaches the environment, played a big role in Tesla's decision to move there. And we also think we'll see some, larger companies influencing, some of these communities to make some decisions. But Mike, do you have any comments on climate and the role that played in y'all's decision and your analytics?
Yeah, and I think the biggest thing that obviously that we've seen that we think climate has driven as well is just the pure population growth. If you just see where folks are moving, it's been a pretty consistent net migration from places like the Northeast into the Sun Belt. And as we move forward here and people's business models change from where they need to be to perform their job, or where companies may be moving their actual brick and mortar offices to different locations. I think the population growth will continue in that direction to, through the Sun Belt. And that's where we've seen the most opportunity.
And again, I think this is something when you look at it, 24 months ago, we were looking more at climate the way that Mike just laid out in terms of where are people moving. They're moving to the warm weather. And I think also this is interesting that in the early stages of the pandemic, there was this belief that once summer got here, it was going to go away. And we thought, well, if that's the case, everybody's going to move south. But there was, we knew that there was a migration into the warm weather climates. And these data points took it beyond that in terms of what we're looking at now in terms of how cities are managing this growth, what they're doing with their green initiatives, pollution indexes, et cetera. So it's, again, it's just something that we looked at one way 24 months ago, and we're looking at it a different way today. And then probably one of my favorite slides is managed supply. And the example I give here in people's mind, we throw out Austin, Texas a lot. If Mike and Aaron and I went to build something in Austin, Texas, from beginning to the time we actually broke ground, it might take us 3 years. It might take us 5 years before we complete the project. We could go up to probably Lubbock, Texas, and have it open in a year. And so we like going to towns where there's some kind of managed supply. Aaron, how do y'all look at managed supply from a lending perspective?
It's one of the most important characteristics that we can look at, especially for a newer project. The last thing we want is to make an investment on a property that's doing gangbusters today, but we know that there's going to be 2,000 new deliveries within a 3-mile radius of the property in the near term, and it doesn't have the job growth or net in-migration to support it. That's a problem for us. So that's a key characteristic that every lender would look at, because in some markets where we've seen overbuilding, things are fine year 1, but by year 3, occupancy is diminished as a result of new deliveries, and that's not a good situation for anyone. So managed supply is understanding what the supply is very important.
Mike, I don't mean to drop this on you, but since you do have a connection with Balfour Beatty Construction, what are y'all seeing in terms of construction costs? If y'all have that conversation sitting around the conference table?
Yeah, I mean, the construction costs just in 2020 were completely variable from month to month. We saw between January of 2020 and June of 2020, lumber prices go up 300%. Rebar prices, the basic workings of building these properties, have increased dramatically. But the kind of side piece to that is that there's so much competitiveness on that side of things that overall construction prices have slowly increased because the subcontractors are being so aggressive on their pricing because there's such a backlog. So they're trying to build up their projects as they go forward into 2021. So it's a strange anomaly that we see going on. Folks on the development side still want to develop, and the pricing has overall for their projects have remained, but the actual material costs are ever increasing. So the margins are decreasing for those subs and the contractors. So, we feel like there's a possible bubble to be had there, depending on where prices go forward. But that's what we're seeing on the construction side of things.
One of the more interesting statistics I've seen come out lately, I think I saw the number was in 78 of the top 100 cities in the US, it's cheaper to rent than to own because the cost of housing has gone up tremendously. I think it was up like 7 or 8% this past year. And while there's a rush to build a lot of single family housing, even some single family housing rental complexes, what I'm hearing more and more is, it's just more expensive to build a house as it is to build an apartment complex per unit. And the profit margin in single family housing is tremendous right now. So a lot of the workers, a lot of the materials, a lot of the approvals within the cities and counties are going towards single family housing, which I think is going to ultimately throttle back development in multifamily. And we already have a shortage of housing in this country. We're about 2.5 million units short. I don't see anything out there that's going to alleviate that problem. You also have the issue of the role that government entities play in managed supply. In some markets in California, I've heard 35 to 38% of your project cost is actually getting through government planning. And that you just cannot continue at that pace. They've got to figure a way to bring down housing costs, but I'm not sure how they're going to do it. But I think in the long term, apartments are going to continue to be the viable point of access for residents in any particular market. So let's get into an example of how we use the data. So Mike and his team broke this data down into recovering markets, fast recovering large markets. And the first example we use of that, or the example we use is Tampa, Florida. And I know Aaron will have some comments on Tampa as we get to this slide. But here are, if you remember, we had 8 data points that we measure. And Mike, it looks like Tampa clicks off 7 of them. So it must be a good market.
Yeah, Tampa is one that kind of bubbled to the top. I mean, it ticks off a lot of the data points that we're looking at, just from a previous how it's performing pre-pandemic and what we see going forward. And to be honest, the pricing that we're seeing on the buy and sell side kind of has proven it out that there's still plenty of demand in the market for Tampa, and from a comparative standpoint, we think it compares well versus other of the larger cities in Florida. We like Florida just in general, but we think Tampa is at the top of the list from that standpoint, comparing to some of the other investment opportunities and cities within Florida.
Aaron, how do your lenders look at Tampa?
They like it. It's the housing supply is short, and to Mike's to paraphrase Mike of a moment ago, people move south and they move west. They don't move north and they move east. And Florida as a whole is attracting people from all over the country, not only to live, but also companies for jobs. The fact that they're short on the housing that they need to accommodate all the net immigration, people are moving to Tampa, and they need a place to live, and that's not going to change anytime in the near future.
Looking at Florida just in general, larger, you mentioned that was the #1 destination for people to move to in the U.S., Aaron. I think I saw a statistic. In fact, Mike Corselli may have shared this with me, that over the last few years prior to the pandemic, Florida was the #1 state that attracted people from Europe and some of the Eastern countries were coming to Florida as opposed to others. And one of the questions that's been asked is, will the impact renewal of immigration have on gateway city investment? I think what you're going to see is, I don't think you're going to see as many immigrants coming into the gateway cities. I think they are going to go more directly to the hot job markets in Florida and Texas, Arizona, and the Southeast. And I think that's what we'll continue seeing. But it looks like that, Florida is a magnet not only for the U.S., but for the world population as well. Jumping to another city, this is an example of a faster recovering small market, Charleston, South Carolina. And Mike, I'll put you on the spot again first. Tell me why you like Charleston. I love Charleston, but tell me why you like it.
I think generally, pre-pandemic, it was already showing growth in rental demand. They had year-over-year rent increases above 3% for the past 3 years. So it was already heading in that direction. One of the biggest things that we like about Charleston is just the access to transport. Being on the coast there, we feel like that's a great qualifying factor. There's some other small markets like Charleston that we think that's a huge driver from a logistics standpoint. And then, obviously it's kind of in that Sun Belt region. So you do have net migration into South Carolina and into Charleston in particular. And it's diversified its economy more outside of the tourist side of things. It has a large government and military presence in Charleston as well. So all of those things combined, from a small market perspective, we think Charleston presents a good opportunity.
So here's my take on Charleston and South Carolina in general. We own, I think, Mike, we have 3 properties in the South Carolina market, or have had them, and in North Carolina. So South Carolina, so again, just these little things you notice when you're in real estate. When you drive through the country, especially the Southeast, the minute you hit South Carolina, because the roads get deadly silent. They have spent so much money on infrastructure. It's a beautiful state. It's well maintained. It's well governed. South Carolina, prior to the pandemic, had the lowest unemployment rate in the country. And one reason for that, and I think one of the questions we had was, what do we look for specific to workforce jobs? Is there a specific data point? I tell you, nothing specific, but these are kind of characteristics we look like. So the state of South Carolina was trying to re-implement itself as a manufacturing hub in the Southeast U.S. They have programs that attract a lot of the automotive manufacturers, especially out of country. BMW and Volvo both have plants there. Michelin Tires has plants there. I think Titleist golf balls is there. Yes, give them some credit. But one of the things that South Carolina did was they started this public-private partnership program where they created an internship program with these companies. And they basically said, hey, if you will create a job that's going to pay, workforce housing wages, $40,000 to $80,000 a year, we will pay you, we will subsidize half the cost of putting that employee through a training program if you hire them on. And so we saw a workforce that wasn't just given any job to make money, but we saw a workforce that was attracted to professional, long-paying, high-paying jobs. And people wanted to go to work. I forget the term, but the effective employment in South Carolina was just tremendous. So these are these little characteristics that add up to something big, and why we like South Carolina, and will continue to invest there, we think, in the future. So this is an opportunity market. And Mike, I think the way you categorize them is there's something unique about these markets. You weren't sure how fast they were going to recover, but it was probably going to be, more than 18 months to 2 years before they really hit their stride again. And I guess one reason for that, Mike, and Aaron, you can comment on this as well. Some of these markets, and we'll see a list of them in a minute, we're doing so well. When you shut that engine down, you can get it started, but it's going to take a while to get it running back up to that full speed like it was again. So these are the characteristics of Orlando. And Mike, why don't you comment on the Orlando market?
Yeah, so Orlando, we felt was a longer term, quite frankly, the unique qualifier here is Disney Universal and the just the sheer mass of people that they employ. Orlando spent a lot of the last decade diversifying itself from a employment standpoint, but at the end of the day, like Aaron noted, Las Vegas, Disney kind of rules the day there. So, the shutdown there really impacted, we feel, Orlando. And, despite all of these qualifiers and the tailwinds, Orlando has been a hot market for the past 4 or 5 years from an investment standpoint. But one of the things that our analysis pointed out is, as rent growth and rental demand continue to increase there, and the rent growth was strong comparative to a lot of the other MSAs and cities in the country, income growth there was pretty stagnant. Income growth wasn't growing, so the affordability there continued to decrease. So that's why we feel like this is a longer term market from a recovery standpoint going forward. So not that we don't like Orlando, we like Orlando. Pricing for us will rule the day in Orlando. We think it'll recover. We just think it'll be a longer haul.
Aaron, is that the lender's view on Orlando?
I don't think that there's universal consensus on Orlando within the lending community. I can tell you that some lenders are cold on Orlando by virtue of Disney. Disney is the largest single site employer, I believe, in the world, with close to 80,000 employees just at Disney World. And there is a camp that thinks that concentration is too much, and as a result are not very, very long on Orlando. On the other side of the equation, there are many lenders that think that the fact that you have those jobs there and the quality of the product that both Disney and Universal deliver, they think that Orlando is fantastic, and they're long on it. So it really comes down as a case by case who the lender is, and then also the particular asset characteristics for a subject property. So in my view, there's not universal consensus for Orlando. It's very bifurcated right now.
Yeah, I think we fall into that camp as well. It's very much market driven. I think the villages kind of dip down into that Orlando community, and while that's an ownership facility, there's a lot of economic drivers around it, so we like that. And what I tell people is, yeah, we're not sure. I agree with Mike that we look at Orlando as a long play, but at the end of the day, when I'm scratching my head, I go, some of the smartest people I've known work for Disney and Universal when I used to live in Los Angeles. Bright men and women, very forward thinking. They have invested so much money in this market. They're working with us to figure out how to get this back on track. And when you've got that kind of talent and brain power and capital investment in a market, it's going to recover. But as Mike said, you're just not really sure when it's going to hit its stride again. But we know it's not going to be a ghost town. So we like that. So I guess kind of looking at the bigger picture here, where do we invest and where does the data lead? So this is the markets that we've identified as the fast recovering large markets, fast recovering small markets, and opportunity markets. These aren't the only places we would invest, but these are the ones that popped up with those very high ranking systems. And we then tend to focus, I'm not sure if it's very present on the screen, but we tend to focus on that smaller circle you see down at the bottom, and that's the markets that we like. And Mike, do you and Aaron have any comments on just in general on this slide, or any thoughts before we get into a couple of questions real quick?
No, I mean, my only comment would be, obviously, I think what sticks out is, a bit of aversion at the moment to the gateway cities, and we feel like there's opportunities in these markets, outside of those gateway cities. So, cities like Greenville, South Carolina, and Memphis, Tennessee, present opportunities going forward.
Aaron, any thoughts in general on this slide?
Yeah, no, I think it makes a lot of sense to me. The only thing that if I were to make a suggestion, I would take a look at Albuquerque, New Mexico, as well as Phoenix, Arizona. They're just both of those markets. Although Phoenix is a low cap market as it stands, the number of jobs moving from California to Arizona is incredible, and likewise for Albuquerque. You know,
Well,
it might be something to look into for sure.
We'll put that on the expiration list. I mean, certainly the demographics are there, but you know, as you mentioned, the pricing has been pretty high. Mike, early in the pandemic, you were really bold and made a prediction that you didn't think there'd be that much pricing dislocation overall in the market, and you know, that's what we're seeing. Would you and Aaron like to comment on where you think pricing is today relative to where it was at the beginning of the pandemic, and just in some general thoughts?
I think generally overall across the country, you know, we're continuing to see level, if not, you know, decreasing cap rates in a number of these cities. I think where we've seen dislocation is more in the urban side of things and some of the larger cities. So we feel like, you know, what we've been investing in kind of the suburban locations, we're seeing pre-pandemic pricing and cap rates going forward, because I think everyone realizes that you know, it hasn't hit those locations and it's kind of transient in nature, so everyone's pushing forward. And I think, you know, you saw it in fourth quarter acquisition volume and what's going to happen here in 2021. So we think it's spotty at best, and we think it's kind of just located in more of those urban locations where they've been hit more from the pandemic and people, you know, working from home or even moving to the suburbs for their jobs.
Go ahead, Aaron.
Yeah, I couldn't agree with you more, Mike. What we've seen is your garden style run of the mill suburban apartment community. You know, the bread and butter business has done fine. Collections have remained strong. There's been year over year rent increases, which is very surprising. If you'd asked me at the beginning of the pandemic if we'd experienced that, I would have said, you know, no way. But the suburban stuff has done fine. Where we have seen diminished value is it largely in the urban core that's expensive and small. And you know, people don't want to be in a small apartment in San Francisco if they can't leave their house, and that's just the way the world is right now.
One of the people on the presentation today, Catherine, is asking, isn't Washington D.C. area overpriced? She says, I live here and prices are crazy. Mike and Aaron, what are your thoughts on Washington D.C.? I like the job growth there, but the pricing scares me a little. What are y'all's thoughts?
Yeah, Mike, you take that.
Yeah, I mean, we see DC in that same vein. You know, it's an affordability issue from the DC corridor perspective. You know, it's deal specific that we look at from an investment opportunity. You know, one of her comment kind of leads me into why we like Philadelphia a bit more than the DC and New York is it's kind of sandwiched in between. You know, you're an hour and a half train ride both ways. So we do view DC as a possible affordability issue, but the job stability of the DC corridor makes it kind of a deal specific opportunity for us.
Aaron,
I would agree with that. With a new left-leaning administration that is probably going to expand government, there may be more jobs in DC in the near term, and as a result, you know, more jobs, stable jobs, that leads to rent increases, which leads to value increases.
A quick one here, and we have a couple more. And Mike, I think we have a few more minutes left here.
Sure.
So, when will Austin be considered overpriced? I kind of think Austin is overpriced right now, but I think there might be pockets of opportunities from some distressed sellers that might be in the kind of the wrong place in the wrong time. But what do y'all think about Austin?
Yeah, every time I think Austin, pricing couldn't move anymore. I'm knocked over the head every time I look at one. So
me too, Mike.
You know,
you go there and you count the cranes. And they
Yeah,
just keep
so
popping up.
I don't think it's going to end anytime soon. Just the job growth that is there, and it's generally where the 25 to 34-year-old wants to live in a high tech environment, and everything Austin has to offer. Do I think it's going to be gangbusters for another 10 years? I think it has to slow down at some point, but I don't think you're going to see a crater in Austin values anytime soon.
Do you think Elon Musk has recrowned Austin as the tech capital of the world?
It doesn't hurt, that's for sure.
Yeah. A number of people are sending me questions about specific towns, and what I would offer to you is rather than go down some of these, feel free to, Michael has my information, email me or call me, and I'll open the database and share our thoughts with you on very specific towns where you might be thinking about investments or living or whatever. So please don't hesitate to call me after this session with that particular information. I did see one question here, jumping over to student housing, since we all do a little student housing work. So two-part question from Brian. Have you articulated a view on how the impact of COVID-19 on remote learning will alter the need for student housing going forward? If so, how has that been integrated into your acquisition or disposition view? So as I've mentioned, I'm on the board of two universities with their business and real estate schools. And it has been interesting. I remember I was on a call at the University of Florida, and the vice president of the dean of student affairs said, I hate to say this, but we have no idea where about 20% of our students are. They're online, they're participating. He goes, usually I can tell you where every one of them is living, and we're having trouble. So we're seeing a couple of things. I still have a son in school, and he just doesn't even think of COVID-19. He's extremely frustrated that he cannot attend all of his classes in class. These kids, these students want to get back in class. He also has the luxury of having lived away from home. He doesn't want to live at home again. He wants to get back to his apartments. And so we're seeing an uptick. We saw a dip in the student housing leasing sector this past year because there's uncertainty of coming back. But as more and more of the schools have opened, and I'll tell you, whichever one of the football conferences started playing football first was a huge boom to our business, because then the kids really wanted to get back to campus. But we have seen a desire in the university, especially on the student side, that they want to be back in school. But I think one of the impacts we're going to see that's positive for student housing, and then I'll let Aaron and Mike comment real quickly, is that the schools are looking at lower density. They are not doubling and tripling kids up in rooms anymore. The parents will not allow that. They don't have the money to rebuild more dorms, so it's pushing more kids off into the student housing sector. We're seeing a slowdown in terms of when they lease, but they eventually do lease. Quickly, Mike, do you have any thoughts on the student housing sector and how COVID might impact it?
No, we're seeing the same. We have a public-private partnership division within Balfour Beatty that builds on-campus housing, and we're hearing the same from that group as well. Is that, at the end of the day, students don't want to be at home with their parents learning. They want to be in the classroom, or if not in the classroom, in their separate apartments and not at home learning. So we feel like it gets back to where it was, and the influx of capital for student housing is still there. So we see it the same, and to echo you, Ernest, it's how they build for their dorms going forward, that we think and are being told we're going to see less density even on campus, which is going to push students off campus as well. So we just think we think it'll get there. It might not be tomorrow, but we think student housing from a long play is still there, just because the fact that students don't want to be living at home.
One last question, then Mike will jump off. I think this is an important one. It has to do with the foreclosure moratorium release. How will it have on these investments, and will pricing significantly decrease? One of the real surprises during the pandemic has been the number of people willing to pay their rent. I think when you take out the gateway cities where rent collections were horrible, but when you get into these Midwest, Southeast, Southwest, people paid their rent. They paid it early, they paid it on time, because I think this goes back to Maslow's hierarchy of needs. People need a place to live and they need food. and they protected their housings during this pandemic. They didn't go on vacation. They used that money to pay rent. They did for a lot of things. Landlords worked with people to put them on rent payment plans. So no, I think if anything that we're going to see after the moratorium is lifted, we'll continue to see high rent collections because I think, at heart, most people are good renters. And that's my comments.
We saw level rent collections. I think if you look at NMHC's or NAA's surveys and all their data points, I think in general across the country, it was only down 1% year over year to 2019 compared to 2020, same month rent collections. And like you said, it was primarily the urban or gateway cities. So I was pleasantly surprised going into it where we came out on the collection side.
We're approaching the end of our hour. Michael, thank you and the two from FLIA for doing this. Mike Price, Aaron Cardwell, you guys are not only great friends, but great business partners. And I appreciate what you do for us, for our investors, but more importantly, I appreciate what you guys have done for the residents in our communities to give them great places to live and call home. And wishing everybody continued safety for you and your families as we look forward to great opportunities in this country. So Michael, you and the team at FLIA, thank you very much.
Ernest, thank you very much. Thank you for being a part of FLIA, and the presentation today was excellent. I appreciate the whole team that did it. Thank you to Apex One for being a sustaining member of FLIA.